This is regarding Quarters Inn, which is our newest project under contract in Rantoul, Illinois. It is a 50C6 offering for accredited investors, and it is being brought to you by TFMS Holdings in partnership with Value Add Fund. Okay, so the opportunity here, guys, is Quarters Inn Complex, which is currently 198 units. It's an average of 550 square feet per unit, but we're going to do some repositioning to combine some of these units. We're going to make half of the building consolidated into larger units at 1,100 square feet. So it will be a combined total of 148 units in the end. And we're picking up this property based on the strong relationships that my partners have in that local market at a discounted price of $900,000. And we're trying to raise a total of $4.7 million for the planned rehab. Our projected IRR for this project is 19 to 24%. And the reason that that is a range is because we are extremely conservative in our underwriting. And of course, we want to project the worst case scenario, but we are also forecasting a lot of upside in this opportunity. So hopefully that would just be the icing on the cake. And again, we're trying to raise $2.5 million total, which is the amount that's not being financed. So page forward, please. Okay, so basically this hotel as it stands today was prior ownership. The property was provided to us again by the local bank that currently owns it for a price of $900K. These types of properties are bread and butter. We project that upgrading the exterior appeal and property amenities, unit interiors will improve the overall operations. Our vision is to turn the Quarters Inn into a long-term and short-term rental asset undergoing a complete rebranding. We plan to perform major renovations and improvements to the property over the course of the first year. And we have over $4.7 million in construction costs budgeted for this project. So basically, again, there's two standing buildings. We're going to take one of the buildings and convert 100 units into 50. And we're going to keep the 98 units as they stand as short-term. So again, this is going to take about a year, and we project the asset to be fully operational by the start of the second year. So based on industry averages, we project the short-term rentals to operate at 50% occupancy, while the long-term rentals will operate at 90% occupancy. Okay, so the whole time for this project, it's a standard 3 to 5 years, which you'll see in most multifamily deals, all depending upon the market conditions. Like Kevin mentioned, we will have multiple exit strategies. We will be picking up the property with a 2-year bridge loan at a fixed rate of 8.99%. And we're going to do an exterior renovation with a budgeted amount of $6,105 per unit and interior reno budget of $25,891 per unit. Currently it's a C property, C asset class, and a C area. Hopefully by the end of repositioning, this will be closer to a B asset class based on its age and amenities. Again, occupancy for that area, we're expecting and projecting 90% for the long-term side and 50% for the short-term side. So we're offering a preferred return on this investment. So initially, like I said, there's going to be a 1-year repositioning period where there's actually no active cash flow. But what will happen is that the preferred return from year 1 will accumulate and be paid out in year 2. We'll show you some illustrations of that a little bit later in the deck. We're asking a minimum investment of $100K per investor or per share per unit. And the funds are due no later than November 20th. And just to reiterate that we're expecting this project to be fully operational with income coming in after the 5th quarter. So 1 year repositioning, 3 months with operating expenses. We're going to go ahead and pay out those distributions on a quarterly basis. Okay, so this is the way it breaks down in terms of your return. Basically, there is an initial investment of $100K. Year 1 is repositioning, no dividends paid out. Year 2, your $10,000 pref rolls over into year 2 and you're paid out $20,000 in year 2. At that point, we will refinance the property for a stabilized long-term debt, and we will be offering a repayment of your initial investment at that point. What remains in the property or the project for you after year 2 is your equity interest. So over the next 3 years, you'll be paid out an average of $10,000 in dividends per year, which comes to a total cash flow payout of $50,000 plus your equity share above the pref, which is $51,000 approximately, and your return of your initial investment. So your total projected investment value is $201,000, $201,939, which is a 2.01x multiplier on your investment, with an average cash on cash return of 10% in the first 2 years.
Yeah, and I was going to also add on the equity split. Currently, we're going to have it at a 70-30, 70 to the LPs, 30 to the GPs. We have a 15% hurdle in place, meaning once you hit your 15%, that the equity is going to split 50-50. All the stuff that we have in here and all the projections that we have in here reflect that 50-50 split hurdle. This is one of those very, very heavy lift projects, and so giving a 15 hurdle, really what it does is it shows, that we're doing exactly what we're planning on doing, and so everybody should benefit. And so in light of our projected IRR, we feel that everybody's going to be pretty happy about this, including ourselves. So
exactly.
So let's talk about us a little bit. Currently, right now, we have 257 units. We are in the process of got contracts for more, but currently that's what we have right now. We have a total of about 73 total years combined real estate experience between all of us.